Right. So the segment that I'm going to do is actually based on one of the comments made from our poll. So our poll, once again, was about how many stocks um, individual investors hold in their portfolio. And then one of the commenters mentioned that they hold too many and they weren't sure how to pare that back. So one of the things that we often do for investors is we'll take a look at their current portfolio and just provide them with general guidance on how we see it structured and, generally speaking, some improvements that could be made to the portfolio. One of the big things we see is just too many stocks. So as Ryan said, 15 to 25 or 20 to 25 individual companies in your portfolio. Um, you know, that's a target. It's general guidance, but we see portfolios with 50 individual stocks, 100, even 150 I've seen recently. And these portfolios are just way too unwieldy, difficult to manage. So one of the things that we always say is that it should be part of your regular investment process to conduct a portfolio review periodically. And this should probably be done about every 6 to 12 months. And this is really where you just go through your portfolio, you look at your holdings, and you determine if your portfolio is still aligned with your goals and if there needs to be any changes. So in terms of fine tuning stock positions, this is when you would look at your individual stock positions, potentially as well as your ETF and fund holdings as well, and just determine if there are any changes that need to be made. So some of those may be like rebalancing based on the sector or geographic weightings in Canada relative to the US, rebalancing stocks that have done very well, like Ryan had mentioned, Boyd and Hammond, companies like those, and also removing companies, either because there's been a fundamental change in the business and it's no longer something you consider investment worthy, or because your portfolio has just become too unwieldy and now has too many companies. So this is a challenge for a lot of people because they don't know exactly how to do this. So I figured that I would just go through the process that I take to look at portfolios and provide my general guidance on that. So there's a few steps here that I take, and the first thing that I always do when I look at a portfolio is I calculate the weightings, right? So I want to know how much percentage wise is allocated to each individual sector. I also want to know what the geographic breakdown is, primarily how much is allocated to Canadian stocks versus US stocks, potentially international, if there's any in there. And then how much is allocated to each individual stock holding. So I'm going to focus really on the equity or individual stock portion of the portfolio. A lot of people will have bonds, will have ETFs, funds. Really, though, at Keystone, we're focused on the individual actively managed portion of the portfolio. And that's primarily what we're talking about here. So calculating those weightings really gives you that bird's eye view of your portfolio, and it summarizes it in a way that will help you make good decisions going forward. So once you have those allocations calculated, you want to look at what your sector weightings are. Identify which sectors you're over or underexposed to. So here in Canada, what I see a lot of is overexposure to energy. Sometimes I'll see a portfolio might have 50% or more in oil and gas stocks. I've seen upwards of 80%. Financials as well, another area of overexposure in Canada, just based on the way the Canadian market is constructed. Um, so one of the first things that we would look at is just targeting, well, which areas of the market am I overexposed to? And these are probably the areas, if I'm going to reduce the number of companies in my portfolio, that I'm going to look at first. Not necessarily that all the reductions have to be in those sectors. You may want a strong exposure to that sector, but having too many companies, being too diffuse about it, is not necessarily the best way to go. So target reducing the weighting to overweighted sectors. And then conversely, I would say if you're underweighted in certain sectors, which in Canada would probably be technology, look for opportunities to add. Um, we also want to look step three at the country weighting. So this is primarily going to be what percentage of your portfolio is in Canada and what percentage of it is in US stocks. Canadian investors are very home country biased. I guess you could say that about really any country, but in particular, we're right beside the U.S. market here. geographically and otherwise. And the U.S. market, we've done segments on this before. It's just a far superior market in terms of where they're exposed. So technology is a major part of the US market, whereas in Canada, technology is a very small sector. There are far fewer opportunities. And the US market, obviously, much bigger, but just better diversity of opportunities. So we believe that to set yourself up for success as a Canadian, you need to have strong exposure to the US market. So what is that exactly? Well, it's everything is going to be investor specific, but we think most Canadians could probably have 30% of their stock holdings in US companies, even up to 50% plus of their stock holdings in US companies potentially. This is just going to depend on the individual, but in some cases I will see zero or almost zero or 10 or 15%. And in those situations, one of the things I would advise is to increase the exposure to the US. Now, this could be done with individual stocks, such as through Keystone's U.S. Growth Stock Service. It could also be done with S&P 500 ETF, but one way or another, it should be done. Step 4 would be to review the individual stock weightings. And this really comes down to, those portfolios that have too many companies, too many individual companies. So really when we look at, investment strategy, if you want to be widely diversified with your portfolio or a portion of your portfolio, that's when you want to buy an indexed ETF. That gives you automatic diversification across the entire market. And it's easy to achieve. But a lot of people, when they're buying individual stocks, think that the point is to build a diversified individual stock portfolio. And that's really the wrong way to go about it, because with individual stocks, you want to be focused. The whole point of investing in individual companies is that you are identifying attractive opportunities whereby the risk adjusted return is superior to the overall market based on yours or somebody else's analysis, somebody who you trust to perform good analysis. So you want to be focused with your individual stock portfolio. And that's why we're saying, the 15 to 25 or 20 to 25 stocks. Now, as a general guideline, some people say, I have 30 stocks in my portfolio. That's not necessarily breaking the rule. These are general guidelines. But once you start getting up to that 30 to 40 plus, you really have to look at trying to pare the individual stocks down. And if you want diversification, go and get a indexed ETF. Now, in terms of what a portfolio would look like, an individual stock portfolio would look like with respect to individual company allocations. So if we were to say 15 to 25 stocks, individual stocks is the target, then that would put an equal weighted position at about 4 to 6% of that portfolio per company. So if, for example, that was $100,000 portfolio, that'd be 4 to 6,000 per stock, right? Now, some positions will be overweighted. There will be a select few companies, for whatever reason, that you will have a very high conviction and you will want to overweight. There you're maybe going 10 to 12%. In some cases, you may want to underweight companies. You may like the business, the growth prospects, but maybe it's higher risk or for whatever reason. So a half position is going to be 2 to 3%. A quarter position then is going to be 1 to 2%. But really the core of your portfolio, most of your holdings should probably be in that equal weighted position range. And then some will be overweight and some will be underweighted as well. So in the review of your individual stocks, there are a few questions you have to ask. And one of the questions that we get a lot is, well, when do I rebalance my winners? Like if I have a winner, something that has performed extremely well, I still like the company, when do I know when to sell? And the thing that we always say is, it's not an all or nothing decision. Just because you sell a company doesn't mean you have to sell 100% of it. You could sell half, you could sell 25%, 10%, 5%, depending on the company. But generally speaking, if you have a company that has performed extremely well, once that position size starts to exceed the 15 to 20% range, just as a general guideline, you should look at some modest rebalancing, which essentially means reducing the position. And I'll just give you a really quick example. Hammond Power that Ryan talked about in his segment, it was re-recommended actually in 2017 at 726. It had hit a high this year of 150 in 2024. So if somebody had purchased just a 5% weighting in Hammond Power in 2017, that was 5% of their stock. Even if the rest of the portfolio from 2017 earlier this year in 2024 doubled, Hammond Power would still be 35% of that portfolio. And that would be likely what we would consider to be excessive weighting. Now, of course, in this case, you are sitting on a huge return. You're kind of playing with the casino's money, so to speak. Um, but really, that's an opportunity for you to sell pieces of the company, maybe smaller pieces, as it's appreciating beyond that 15 to 20% total out percentage of your portfolio, just to lock in some profits and rebalance the position, and then recycle that capital into other companies. Um, well, what about the underperformers? Now, sometimes there are underperformers. When do you know when to remove those? Well, really the way that we look at it here is you have to identify the reason for the underperformance. So there are companies that have great long-term growth profiles, but they may misstep for a quarter or two. Um, this is what you would refer to as a temporary loss of capital. This is a term, I believe, from Warren Buffett. He's very specific in terms of separating temporary loss of capital from permanent loss of capital. Temporary loss of capital has to just do with general market volatility, maybe a short-term issue that a company is facing, or for some reason the popularity with investors has declined in the near term, but it's still a great company fundamentally. And the reason that you originally purchased it still exists. So you may purchase a company because you're looking to hold that for a 5-10 year time horizon. There may be a misstep, maybe a change in investor sentiment. The company may not have performed well, but fundamentally, it's still the same business, and all of those reasons are still intact. So that may be a reason to keep the company. Whereas if there has been a major fundamental structural change in the company, then you may be facing a permanent loss of capital. And that's when you really have to review, is there a concrete likelihood of recovery? Like, can I really kind of quantify my rationale for why this company should recover? Or am I just holding it on out of hope that it's going to recover? That's the question you have to ask yourself. And as well, how does the company fit with your current investment plan? So if there has been a major structural change in the company and those original reasons that you purchased it no longer exist, that may be a reason for you to decide to remove it from your portfolio. And then also when to remove small positions. So this is one of the most common things that I will do, or one of the first things I will do when looking at a portfolio that has too many companies. We've already calculated all the individual stock weightings. Most of the portfolios that have excessive numbers of individual stocks, so say 50, 100 companies, 150 companies, they have a lot of companies where the weighting is extremely small. It may be, like 0.2%, but well less than 1%. So as I'd said before, the core of the portfolio, the majority of the stock should be close to equal weight, 4 to 5% weighting, roughly. But anything that's under 1%, you really have to reconsider why you're holding the stock. If you don't have enough confidence in that investment to have a 1% allocation, then you probably just don't have enough confidence to have any position at all. And even if it's a very small, if it's like a 0.1% position, even if the stock performs very well, it's not going to move the needle of your portfolio that well. So one of the things that I'll say, if you're sitting there with a huge number of companies, you want to start paring it back, you're not sure where to start, calculate the individual stock weightings and just consider getting rid of anything that has a less than 1% allocation or weighting in your portfolio. So really just one of the things that I always want to stress whenever I'm talking to an investor, every investor is completely different. So this is not specific advice for individuals. This is really our general guidance. And these suggestions can really be modified to the individual investor based on your resources, goals, risk tolerance. I will also say that when people come and they know they need to make a major portfolio adjustment, just like we say, build a portfolio gradually over a period of time. Adjustments to portfolios can also be made gradually. Now, some of those adjustments, like holding really bad companies or being extremely overweighted in certain areas that you don't want to be overweighted in, maybe you want to make those changes more quickly, but don't feel that you have to make every change on day one. It can be a gradual change. Index ETFs, again, if you're looking for wide diversification for your whole portfolio or for a part of your portfolio, that's where indexed ETFs come in. But individual stock portfolios, they should be focused. Now, you can always have some ETFs for diversification and then an individual stock portfolio to outperform the market. But really, individual stock portfolios need to be focused, and they're not for wide diversification. That's what you would use an ETF for. And that concludes.
I think it was a good summary. No, and I think it. We talked about how many to deploy in a portfolio, how many stocks, how to build that, and now you've got to look at rebalancing and how. I mean, many like one of the things we deal with on a constant basis is clients coming to us from other advisors who have put them in 50, hundreds of stocks, ETFs. And it's how do you cut those? Which companies should be cut? I mean, it's really, you know, like Aaron said, if you just have a 1% holding, I just looked at it. We just looked at a portfolio the other day that had about 40 stocks that most of those stocks were 1.5% or under of the portfolio. And, the client didn't know why they were holding them to one. And, fundamentally, we're just going to look fundamentally at those businesses as well. And if they don't pass our test, we're not going to put them in a portfolio. But if you don't know why, if you're just looking at it yourself, you don't know why you're owning that stock, and or if you did know why originally and it's not, you can't still apply that same rule to that stock, it's a good way to cut that out of your portfolio. But I think the thought that you have to do all of those changes in 1 week or one fell swoop at one point in time is just like, we don't want you to make all those purchases at once. You can make those adjustments over a period of time. There's some simple changes you can make right away, day one, but then there's probably some of those changes will take 6 to 12 months.
Yeah, and I think it was just a good, thing to like cutting your losers. Like it's a market of opportunities, not just a stock market. So again, if all of a sudden one stock that you purchased isn't providing, quite the opportunity that another stock is, why not replace it in your portfolio? So again, I think that people tend to, not sell or cut their losers because again, they're just wanting and hoping for a stock to come back when the fundamentals, there's a reason why the stock is went down. So I always think that is a good point, that it is a market of opportunities, and to stress that to investors.
And it's kind of you're cutting loser on price, not only on price. If a company somehow was up, 20%, but not performing to your expectations fundamentally, you're cutting that from your portfolio, right? And you could have, Aaron said, you could have a stock 20% down, 50% down. It's performing well fundamentally, so you hold that company. You're not cutting just because of the price loss. Yep. You're cutting because the business or the management team is not executing on your original expectations.
Yeah, and I'll just go a bit further on what you guys are saying with probably the most common that retail investors or common investors, that issue they have managing their own portfolio is dealing with loss aversion, or if not, it's one of the top. It's because losses hurt more than what it feels good to have a gain. So if you had a $500 loss on a $1,000 position or a $500 gain, that $500 loss, so a 50% decrease in your portfolio, feels a lot worse than that 50% gain. So people always really attribute that to it's a temporary drawback. They aren't recognizing it that it is a permanent loss of capital. Like Aaron was saying, you really need to be critical in thinking between that temporary loss versus permanent loss. And a lot of people will be dishonest with themselves because they don't want to realize it is a permanent loss of capital. And that's when you end up with those people will say, oh, it's not a loss until you sell type of thing. They end up being that big holders for 5 or 10 years. And it's just a waste of money at that point because you have hit a permanent loss of capital at that point.
It really goes into the psychology behind investing too. And it's part of it that we don't talk about as much as the fundamentals, but it's something maybe that we should talk about behavioral finance a little bit more going forward.